Ladies and gentlemen of the crypto space, we're live on a Friday, August 11th at 11:32 a.m. The levers of the liabilities machine. That's a big machine back there. And these levers are spread across the planet, implemented in respective central bank policy. That's not just, well, it is actually just central bank. It's treasuries around the world of respective sovereigns that produce base money, but central banks are responsible for turning that base money as well as future versions of that base money, sovereign securities debt instruments, into currency liabilities. Now, obviously, the commercial banking system worldwide is completely set up to handle currency in liability form. They don't need base money. Base money is not really a part. Even dollar deposits are instantaneously converted to government debt instruments. So it's just the liability form and the shifting around of entries on commercial bank balance sheets that is the composition of the money that we use at a global level. So there's a whole lot of levels of the liabilities machine, and man, Japan is in the driver's seat right about now. We'll pop it over to the main screen and take a peek. Look at this, 144.891, about to push above the tweezy top of July, June and July, and this is on the weekly. Let's go out to the monthly. This is a precarious positioning for the yen versus the dollar. The dollar is strong and the yen is weak, and this is obviously because of them managing their debt market and their debt to GDP and their debt servicing obligations and the yield on that debt, and this is the implication. It has FX implications, and this has implications on flows to and from Japan. And that has a variety of implications, historically known as the yen carry trade, and where you can borrow in a cheap currency over in Japan and invest in a relatively strong currency here in the U.S. Borrow at 1% and lend at 5%, which is basically, that carry trade is the foundation of commercial banks. Borrow short, lend long. Or, you know what I mean. You borrow cheap in the short term and you lend for higher yield in the long term, to clarify it as best possible for folks that don't know how a carry works. Paul's in the house, Dan's in the house. Light day today. 3 people? All right. God bless. Nobody's surviving. You got to survive these markets. These markets are exciting. This is where all the potential is. This is where all the potential excitement is heading into the next 1-2 years. Now, what was the title isn't really what I wanted to talk about, I guess. I also always really want to remind folks about time horizon versus expectations. Now, the real problem is that expectations contradict time horizon. People have the flawed expectations in the wrong time horizon. And that's why they're not in markets when they start to go asymmetric to the upside. And they're not prepared. You can't be scrambling when markets are extremely volatile. You want to be sitting back and be like, all right, it's starting. When the markets are starting, when it is starting, I'm going to be like, cool, here we go. I've had my positions for years. There's nothing to do. Jen Spartan had recently said that. He's like, he's got nothing to do. I got nothing to do. I'm ready for 2025 with basically no work. I don't have a high expectation of the need for exposure to far out on the risk curve heading into this coming cycle. It'll always start at the core, and then you have your knock-on effects as gains are taken. I mean, that's why they always say it starts with Bitcoin, and then Bitcoin carries over to Ethereum, and Ethereum carries over to altcoins. But that's not the way it's going to work in these future cycles, particularly because of the emerging market concept, and especially now the proto-emerging markets. This is all new. This is all post Q4 2019. This is 2020 and beyond. This type of market cannot be compared to preceding markets such as 16 and 17 and earlier cycles. Those weren't markets. Those are centralized exchanges. That's not a market. When you sell things on a centralized exchange for dollars, what the hell are you going to do with the dollars? You can't park them. You can't do anything. They went off and they did things in TradFi and meat space. But post 2020, this is a market where you got a huge amount of liquidity. Upwards of how many billions of dollars of liquidity? You look on DeFi Llama. Parked. This has RWAs written over why money is parked, because you're able to get capture cash flow associated with RWAs and credit without having to engage with volatile assets. There's been capture. There's dollar capture, or just other denominations as well. But the capture of sovereign value in an emerging market is probably the most important observation of an emerging market. Capital flows in, global liquidity dries up, negative sum game emerges, and between that negative sum game and return to the positive sum game, the cycle duration, the time horizon, how much money, dollars, were captured in that period. And the next one, in the next 4, 8, 12 years, is it going to be more? If it's more, then more was captured. And you want to see higher lows in total capture. And as of right now, the amount of captures since 2019, where the total liquidity in this emerging market was basically zero, it's a monumental amount of currency units. And folks aren't excited? This market is screaming with holy shit. A country, you compare it to a country, a sovereign nation, spinning up capital markets and capturing 70, 80 billion dollars in a 3-year time horizon, part of a global liquidity cycle. Yet they all fled. Yet all the small investors have abandoned ship. They've gone back to their meat space jobs, of which I work as well. And they're like, this is not the place for me. They made it too complicated. The curse of the novice investor is making it too complicated. They think they need to buy and sell at opportune times. And what is this magical, mystical, technical analysis? When it's just own core assets that have captured capital and ride the cycles, because anything that captures capital and survives through multiple cycles will carry the aura of lendiness. And when fresh capital returns to the positive sum environment, where does the capital flow? To the least risk. The least risk is the lindy, the shit that survived between cycles. That's just logical. That's the first destination of capital, and then it's just knock-on effects from there, depending on debauchery and exuberance and large actors capitalizing, and then they're able to just spread capital around to maybe some new projects that potentially have legs, of which there's a few. But you don't have to think there's hundreds and thousands and get overwhelmed. The first thing a novice actor needs to do is to not get overwhelmed, not look into thousands of protocols, look into 10 and understand what they are, what is their service, what is their business purpose, and why it's significant, and why it has survived, all while capturing capital. Sticky capital. Sticky capital is crazy in the market, in an analogous structure to a sovereign nation that's global in scale and scope with no intermediaries required to access it. There's sticky capital. That's crazy. MFN Coom had to go to China to catch you live, my man. I haven't kept up with what's happening with Balancer Aura. Any interesting updates? Yeah, they're expanding to as many chains as possible. And there was a narrative I put forth in 2021, Q4 2021, which was seamless cross-chain. This was before Layer 0. CCIP wasn't even on the radar. And I'm like, we have these centralized bridges, so at some point we're going to have seamless cross-chain liquidity where you're interacting with any chain, and it's like, you know, here. Uh, how could I show you this? Okay, here. Let's go here. So Frame, here, look with Frame. Frame is automatically detects the browser and the Web3 implementation that a portal offers. So it'll automatically select any of the networks that are supported. You don't have to go in and select it. Sometimes you do when it's like source and target destination chain selection being offered, but it'll often select the correct chain without you having to do something like you've historically done in MetaMask and other shitty Web3 UIs. This automatically does it. That's a recent update to their implementation. And at some point, if you do a transaction on Avalanche, it'll source liquidity on Polygon, on Phantom, on Optimism, and Arbitrum, and give you the transaction back on Avalanche. You'll be interacting with all chains seamlessly because the liquidity will be flow seamlessly cross-chain, and that changes the equation, and that's obviously Layer 0 and CCIP. In a crypto native space, obviously Layer 0 is significantly further along, and CCIP just has this grandiose scope and vision of global scale and scope. So it's a whole other story. Two different statuses in the market thus far, but that's where it's heading. And that's a big deal, and that's what Aura and Curve offer, is liquidity pools on these various chains. So they are a critical component to seamless cross-chain liquidity. Liquidity pooling. The most important thing heading into future cycles is to broaden your vision. AMM, crypto assets. No, these aren't AMMs. That is the tool set that it has been built, an automated market maker. Automated market making facilitates liquidity, which facilitates conversion of denomination, which facilitates flows. So that, by definition, in a meat space context, is an FX market, a foreign exchange of one denomination to another. These assets in crypto markets, most of them, at least many of them, have overtones of collateral instruments, voting rights, which has an overtone of, like an equity, depending on how it's constructed, but certainly of currency units. And that's why I define most AMMs in crypto markets not like an exchange, like a stock market, New York Stock Exchange or Nasdaq. I think of them and I see them much more as an FX market, a foreign exchange market, and that's real. That's not just like, oh, I want to see that. That's the exhibition of behavior, the overtones. This is what these markets smell like, what they're doing from a functional standpoint. So, good things from an Aura and Balancer Federation standpoint. Let's take a peek and look how price action has. It's been hammered pretty much, down to $1.18. The question in my mind is who's accumulating? Who's accumulating Aura? That's important to inspect because, as much as they're expanding to other networks, you need to have sterilization and recycling of these currency units. Otherwise, you'd have continued depreciation, and that's one thing that has played out with regard to Curve. Everything's been bought. It's relatively illiquid, and that's a complexity from a debt position. Michael's debt, which obviously manifested itself, but that's relatively interesting considering the amount of emissions it has and its capacity to finance and drive incentives, which drives flow, so on and so forth. It's relatively illiquid. Everyone used to complain back in 2020, 2021 it was too much emissions, and now everyone's complaining that it's too little and it's a liquid. Oh my God. So what do we know? We know this. We know this is just a part of the list. This is the list of protocols that are sucking CRV out of circulating supply, sterilizing in perpetuity, not even necessarily 4-year lock. Some of these protocols are just like, we're locking it in perpetuity, and it's just a rolling lock. So that's why it's relatively illiquid. You have protocols that are literally just sucking supply out of the market. So that's something to consider from a balancer and aura perspective, or any incentive-based system, is who's sterilizing excess supply. And, I would love to see a list just like Curve put out about its federation, who's sterilizing excess supply for aura. And it can't just be retail. It can't just be people buying and market actors. The big thing about this list is that these are protocols that are doing it deterministically. That's the whole purpose of the protocol, is to literally just buy and lock, buy and lock. And they have their own incentives. So they are themselves are incentivizing this disruption of circulating supply of the base asset. So all of these protocols collectively are strengthening the core financial flows of the base currency unit of this federation. And that's an important observation. So anytime you look into an incentive regime that has either an inflationary or disinflationary incentive currency system used for incentives, you really got to find who's buying it deterministically, not just actors buying it opportunistically. Hence why I'm more bullish CVX and Curve ecosystem. As of right now, the only system that has a federation of sterilizers is Curve. You see proto federations. That's probably best way to define this. I defined L2s and Alt L1s as proto emerging markets, and Ethereum mainnet's an emerging market. These are, and Curve ecosystem is a federation. Fits all the characteristics. This would be a proto-federation. We need to see more sterilization, more stability in price point, more deterministically locking protocols that are consuming it for what? For control of governance, of emissions, to finance liquidity depth. So proto-federation, and then if you're on the proto-emerging markets, Alt L1s, Alt L2s, and you're talking about a proto-federation and a proto-federation and a proto-emerging market, you're out on the risk curve. Even though you may not think you are, by definition you are, because you see protocols that have stronger status with regard to these concepts on mainnet. Everything is relative, and it is relatively less established with regard to the recycling and sterilization requirements for stability. So, in hindsight, I sized this position correctly. It's quite productive. I expect continued depreciation. Depreciation brings opportunity. Just like what's going to play out with commercial real estate, you're going to have ridiculous haircuts on the properties, and there's going to be opportunity because of the significant discounts. So we don't know where things will be next cycle, but discounted prices present opportunity and the emergence of new actors attempting to capitalize. And that's not just from a price point standpoint anymore. The cash flow is obvious. So enterprises are going to establish themselves based on the potential flows, not just the speculative price action that results from irrational exuberance. Ritari, what are your thoughts on the direction of Frax with V3? Yeah, this morning with Ben and Jedi, Frax V3 is as big as it gets. Maker and Frax V3 with their real-world asset narrative is extraordinary. The capacity to surface those yields here. And Frax has a leg up because of their FXS ETH implementation, how not everyone stakes to access the real world yield of, the relatively real world yield of Ethereum's base yield, staked base yield. So if you buy 5-year treasuries vis-a-vis Frax, and 50% stake and the other 50% are providing liquidity on curve, you're going to have much more than 5% on 5% yielding short-term treasuries. So that's quite fascinating, considering their FXS ETH implementation carrying over to their bond implementation. So position size is how I've considered Frax, because Frax is not currently a revenue producer with regard to FXS. VEFXS is not a revenue producer. Doesn't have any cash flow, really. It's relatively insignificant. So that is how I factored into my portfolio construction. But just the sheer scale and scope of the things that they've been building, it's hard to not get excited about, but you cannot oversize a position just because you're excited about the potential in the future. I really want to encourage people focusing on X, Y, and Z. And that has to do with cash flow. X is the purchase price of something. Y is the return, ROI, in terms of APR percent you're going to get on a yearly basis. And Z is the potential for it to continue into the future. If you buy something for $100,000 and you are expecting to get 20% return, $20,000 the first year, and Z, what is the potential for that $20,000 to continue to come in as income into the future? And if you base the construction of a portfolio based on X, Y, and Z, you're going to have a nice portfolio. And depending on your risk tolerance with Z, it could be a relatively stable Y cash flow to you on a yearly basis. And that rings of all the overtones of a traditional dividend investor, just deploying capital, as TradFi would say, out on the risk curve into the crypto space. But I would say these yields are actually quite reasonable. It's just that in recent history, GenPop has been massaged into believing 0% 0% APR and cash deposits in a bank account are acceptable. What's the matter with 10, 15, 20%? What's the matter with taking a little bit more risk, 20 to 40%? So these numbers are reasonable under many considerations. Potential cash flow, supply. If a large corporation didn't dilute their shareholders and just suck the capital out of them with capital raise after capital raise, there's great potential for great yields in equities, but they just suck the capital out of retail investors, unfortunately, and resulted in relatively muted yields from a dividend investor standpoint in traditional equities. I just don't see much opportunity there that's not out on the risk curve, especially considering geopolitical risk exposure to a traditional corporation, which has supply chains and humans and employment. And that's why these digital enterprises are so comforting to me, where it makes people in TradFi think that they're going out of the risk curve. I'm going in the crypto. This is the least risk place for capital in many regards. Global scale and scope, no intermediary sovereign required for access. You're going direct to market from any of the 195 countries on the planet. Zero friction, permissionless, no overhead, no real estate, no human resources, no benefits, it's a 24/7 operation by software that's executing optimally, deterministically, depending on the contract construction. So deterministic 24/7, no OPEX or CAPEX from a contract perspective, that's crazy. Come on, that's a reduced risk profile compared to something that has X billions of dollars in CAPEX for human resources from an equity standpoint. This is the least risk environment from an investment standpoint in many regards. Now, the problem is you have to understand monetary policy. You have to understand what money is and why there's a reduced risk with exposure. Look at all the risk that was interpreted from a curve perspective over the last 2 weeks. I'm inclined to think, I've seen some conversations, Mitch's conversations on Telegram channels, private Telegram channels. There was no concern. There was no uncertainty. There was no perceived risk. I get the sense it was just obvious. He was like, all right, I'm going to put a lot of pressure on the markets. I'm going to take out a fair amount of cash. I'm going to make everyone think that it's going to liquidate. It's going to sell. It's going to dump. Everyone's going to buy these assets that I have, ridiculous concentration, and then that's going to move the price up. I'm going to deleverage the risk, the leverage on the debt positions on-chain markets. And this is what played out. There was no panic. There was just execution. So I think when that debt was taken, these scenarios were anticipated in many regards. There's no other way you're calm, cool, collected like that. So there's a risk to a degree, but everyone bought it, and the market spoke, and this is what's going, no, not my calendar, and this is what's going on. This is real, and this is much less risk than a lot of equities. Good morning, everyone. A pleasure. 15 people in the stream, 5 likes. I appreciate all of you. Let's get back to some charts and give everyone a decent perspective of what the hell is going on. Let's look at a fun one. This has been hot recently. $1.61, nice volatility from an LP perspective. The LP has been quite productive. I like the bots narrative. I don't have any insight into entries. Entries are the hardest thing anyone could ever do. I have a fib up, which is nice that it's at the 0.382. It literally bounced right off 236, and now it's a leg up to 0.382. So this is interesting, literally from a technical perspective. It looks like it's following some fib rechases very nicely. So I don't really have insight into this. Coming from Solana, my entry was, much closer to zero than even the zero mark on this chart. So that gives me a lot of bias when I'm talking about just, all right, let the LP do what it's doing, just printing cash flow. But I think the trading bot narrative is interesting. Telegram obviously has shown what it's capable of, and there's been no expansion on the Discord, and this is literally claiming new territory on the Discord front. So that's interesting from a technological perspective, from an addressable market perspective. That's interesting. So this is the most recent thing. This is like one of 2 or 3 things that have presented interest to me in 2023. There's not much room left for innovation. There's not much room left for disrupting an incumbent, disrupting a market right now, especially right now. And I think just as these markets evolve in the coming cycles, the leaders of the space are just going to get further entrenched and just get stronger. I mean, that's what markets do. They concentrate over time. And what has crypto markets excelled at is operating relatively organically, leverage, flush, failure, and capital concentrates. And that's what historically happened with traditional meat-based markets. And most recently in the last 15 years, we've had insolvency intervention and liquidity intervention after intervention. It becomes commonplace. That doesn't occur in crypto markets. There's been no bailouts. So there's been a lot of concentration. So I think these markets actually behave much more organically as compared to traditional financials at this point. So in that tone, we can expect serious concentration of capital to the market leaders from an FX perspective, from a credit perspective, from a liability printing perspective, CDPs, from cross-chain messaging perspective. It's not even really cross-chain liquidity. It's the messaging that counts, because the liquidity really needs to be provisioned on each respective chain. And as the SEC loves to talk about, separation of concerns, which is a programming narrative, The concern of cross-chain messaging isn't the concern of liquidity. They're independent of one another, and you don't want to commingle those functions. So I think Layer 0 nailed it with cross-chain messaging. There's a couple of other cross-chain messaging protocols, and it's very interesting how that's going to unfold, especially considering the FX markets that have expanded. Look, Dan mentioned Aura Balancer ecosystems expanding. It's an FX market. So now you have Layer 0 that facilitates the cross-chain messaging and the flow of that liquidity seamlessly cross-chain in the coming years. So that's quite good to see. So expect nothing in the short term with regard to stability. Volatility is still going to be high. Japan is putting a lot of pressure on currency around the planet. It's not really the euro. It's really the yen right about now, especially you can see it very visibly from a technical perspective. Move is actually suppressed. So, this is where you come back to like Mike Howell's global liquidity charts that he posts on Twitter. The global liquidity is relatively stable. And that's because it's not just FX. FX is relative central bank policy and just geopolitical collusion in many regards. But liquidity, that's why we talk about it so much. And liquidity, this chart down stabilizes liquidity in a meaningful way from a global perspective, not from a specific country's perspective, which we're not interested in. We're not interested in what is collapsing inside of the U.S. We're not interested in U.S. equities collapsing. Because if U.S. equities is collapsing and something is relatively stable in global markets, crypto is going to be relatively mute. It's not a U.S. market. You could see very interesting things. What happens if $20 billion flows into mainnet and U.S. equities are down 30%? All right, there's your decoupling that everyone they're like, oh, the correlation between altcoins and Bitcoin and equities, and it's not a U.S. market. It's an international market, directly accessible without counterparty, and that's quite fascinating. This down, you want this down. You want the dollar down because as the dollar comes down, foreign currencies have more purchasing power, and more purchasing power results in more velocity, more activity, more purchasing. So that's the sweet spot. If you see DXY down, USD JPY down, USD EUR down, and USD CNH, these are the key markets. But the dollar is presenting some strength, which is drawing or interrupting liquidity strength of international fiat currencies. But move down is increasing the encouragement for money printing offshore, which is keeping international liquidity conditions relatively stable. So that's why the markets are relatively mute. That's why they're freaking boring. This is the time to be excited about future conditions. Now, not when the markets are hot. Come on. Got some other stuff, but that's not worth really going over. It's a little too technical. Curve down at 59 cents. Great. Shitload of volatility. I mean, after what just happened between the Aave, mega short attack back then in November of 22 and recent activity, come on, it didn't even print a lower low compared to the Aave short attack. Quite interesting to see from a technical perspective. And even the Aave short attack is above the lows back in November of 2020. So this is still presenting a decent inverse head and shoulder pattern. So, just I don't have any expectations for significant appreciation of anything in the short term, but we're not too far from a technical moving average from a monthly perspective, the TWAP here. So historically, when you look at like Bitcoin and you zoom out to a monthly and you hide the price point, hide, and you hide everything except the TWAP. Let's go out to like a 3 month. This is a chart I've looked at And the 6 month is interesting too. So if you ignore price point and you buy when it's below the TWAP, you're in a relatively comfortable position for it to be a good purchase price. Now, it's even more so from a 6 month perspective. Um, so if you bought at the 16 low, uh, it was about 16 and change, 16,969. Look, it never broke the TWAP, the 6 month TWAP. The most recent bearish market in Bitcoin that was like, oh my God, it's going down to 16. And it didn't even break the TWAP on the 6 months. So if you nailed these lows, hiding the price point, the TWAP filters out the noise very nicely. So you might not catch the 6 month. Look how short this chart is. No, not many people look at the 6 month other than my crazy self. But if you even take the 3 month on a Bitcoin and you buy below the 3 month TWAP, you're in a relatively good position with regard to trend. And trends have a way of expressing directionality. 3 month TWAP is a hell of a trend line. So obviously, if you bought at $60,000, you can have a freaking mean regression. Of course. So you want to buy below it. Those are your opportunities. And if the system's breaking and this invalidates, then really the system is breaking and everyone's screwed. So this may actually offer some insight into the entry process and a way to simplify the entry process with regard to at least the macro assets. You could do the same thing on Ethereum. 3 month TWAP, if you bought at 16 and change, you're below the 3 month TWAP. The odds are highly in favor of it mean regressing towards the average, which is up about 17 and change. And we're at about 18 what and change, 1845. We're a little bit above the TWAP, so we're in a very big choppy region. So expect volatility between 16 and change and 18 and change. And anything above, you're not like if you start to see 3,000 again on Ethereum, this 3 month TWAP doesn't move. You're a way extended standard deviations away from the TWAP on the 3 month. If you see 3,000s, it needs to be elevated for a year or two in order for the TWAP to get up to the 3,000s. So that's not buying. That's not the buying opportunity. The buying opportunity is below the average price, expecting a mean regression back to the upside. I hope that helps, ladies and gentlemen. Assumes in the house. That's the last one. I appreciate all of you. Let's wrap it up for the weekend. I hope everyone has a cool, calm weekend. Focus on anxiety. Keep that anxiety low and stay rational. That's the only way to stay in markets long enough for markets to actually do well for you. 15 people remaining in the stream. 5 likes. Hit that thumbs up button. I appreciate all of you. Link in the description for Discord, the most rational conversation about these irrational crypto markets in the entire crypto space. For the few that have remained and remain rational and have stayed in Discord, I appreciate all of you. And it's going to be an interesting ride over the next 1 to 3 years. Time horizon is everything in all markets, not just these markets. I will see you again on Monday. Have a good weekend. Peace.